accounting concepts. Really, what you need to start thinking about is turning off what you've learned about financial accounting and the rules and regulations that came out of GAAP, or generally accepted accounting principles, and flip your hat around, because no longer do we have to abide by all of those rules and regulations when it comes to the presentation format of what we do in managerial accounting. Really, our focus in managerial accounting needs to change a bit as well. And this slide kind of says it all. It provides financial and non-financial information for managers and other decision makers. Basically, managerial accounting is going to focus on the internal decision maker, people inside the company, and on the other side of that, financial accounting or GAAP accounting focused primarily on external readers or external users to the financial statements. So it really is different, because the person that you're creating information for really is using that information a different way. So managerial accounting focus on internal decision makers. When we start thinking about managerial accounting, the primary thing we need to think about is that we're looking at the future more than we are the past. And that's why I'm just going to start here in this lower left corner. We can consider the purpose of managerial accounting to start with planning. In planning, we have strategic aims, there's long and short-term goals, annual budgets. We're going to lay down a plan. Well, if you're laying down a plan, you're really thinking about what is to come, something that's going to happen in the future. And then we'll just kind of go around the cycle here. We monitor that plan. Well, how do we monitor it? We monitor it by putting it side by side with actual results, what really did happen. And with those actual results sitting next to the plan, we then have the ability to control. We can measure, we can evaluate, we can provide oversight. Basically, we're going to find out what's different from the plan. Did we go over? Did we go under? Did we hit our goal right on? And then what do we need to do to revise the plan? And that's what feedback is about revising the plan, revising our strategy, revising our goals, revising our budgets, and the cycle starts all over again. Let's just talk about the nature of managerial accounting and do a side-by-side comparison, really, of managerial with financial accounting. Financial accounting, which is what you would have learned in Accounting 211 or Accounting 101 if you're at a four-year university. Again, I'd already mentioned this, the users are a primary focus. In financial or GAAP accounting, we deal more with external users, the investors, the creditors, other people outside the organization. But in managerial accounting, we're going to deal primarily with those inside. The purpose of the information for financial, it helps external users make decisions, and in managerial, it helps inside users make planning and control decisions. Financial is structured and controlled by GAAP. Definitely rules and regulations when we're talking about financial accounting, but you'll see that managerial accounting will be relatively flexible in how you do your work and how you make or how you present your reports. In financial accounting, these two kind of work together. Financial accounting is usually only available after an audit is complete, and we're dealing with past historical information, and we're dealing with a very set period or time frame. So it's going to be weekly, monthly, quarterly, semi-annual, things like that. Whereas managerial accounting, we can use the information that we have on hand right now, and we're dealing with the future. In financial accounting, we're looking at the bottom line for the whole organization. You hear people say all the time that CPAs are just bottom line focused. They only care about net income, they only care about total assets, total liabilities, and total equity. And to a degree, that's probably true, because those are the indicators of the business as a whole. But in managerial accounting, we tend to focus more on the little pieces and parts, the details that make up the whole organization. Instead of looking at a product line, we want to look at a project. We want to look at processes. We want to look at departments and divisions. The little things, the nitty-gritty details is what we would look at. In financial accounting, everything or all of the information is based on monetary information. It's all about the money. But in managerial accounting, while it is mostly monetary, there are also some non-monetary or qualitative factors that we get to take, and we'll talk about that right at the end of this lesson. We shouldn't go any further without talking just a little bit more about fraud and ethics in managerial accounting. If you took 211 with me or any other instructor at Germana, we talked about fraud and ethics in financial accounting and just how rampant it really is. Unfortunate truth is there are crooks in the world. But let's kind of flip the script and talk just about the management side. Again, with management, we're talking about laying out plans for the future, and we're talking about people inside our organization. In management accounting, we focus on cash controls and internal controls to help us kind of thwart any kind of theft that's happening from inside, not from outside in, but from inside in. So that's what we're looking at there is, making sure that we have some type of code of ethics or some type of map to help accountants involved in solving ethical dilemmas. Terrible statistic there. Some estimates have that say that average U.S. business loses about 5% of annual revenues to fraud. And if you think about annual revenues across the entire United States business structure, 5% is just a massive number. All right, so as we start to think about managerial accounting, we start to think about laying out plans for the future, we really have to start thinking about the things that we can and cannot control. We're going to talk about that a lot more in a future chapter, so I won't harbor on it too much, but if you are thinking about what you can and can't control, typically if you think about money coming in or your revenues, while you might have an influence on how much money you can make, you can do more advertising, you can get out and start hitting the street, with somebody with a sign holding up saying, please come buy your stuff here or whatever. That's an influence, though. That's not control. The things that you can control typically in any organization are going to be your cost. You have the ability not to spend money or to spend more money or to maybe try to figure out a way to spend less money. So you can certainly control your cost. Well, in order to understand how we can control cost, we need to understand how we can classify cost in different ways, because some costs themselves are controllable, some costs are not controllable. So we really need to break cost down into different classifications, because it will help us get down to those details that we need in order to properly report from a management perspective. So the first way that we're going to classify cost today is that we're going to classify cost by their behavior. Cost can either behave in a fixed manner or in a variable manner. We have fixed cost or variable cost. Fixed cost is pretty simple. It's a type of cost that doesn't change when any other activity changes. And when we're talking about activity, we're really talking about sales, because that is the activity of a business. That's what we do. We're in business to sell something to make money. So that is truly the activity. So what total fixed costs do is that they don't change whether you sell nothing or whether you sell a lot. I don't care if you sell 1,000 units, 100,000 units, or 0 units. Fixed cost is going to stay the same throughout that range. A good example of this would be rent. Your landlord really doesn't care if you sell anything or not. He still wants to collect the rent from you. Therefore, rent would be a fixed cost. It's not going to go up or down if sales goes up or down. On the other side of that, variable costs will change in proportion to activity changes, or will change in proportion to sales. A really good example of variable costs, we'll kind of go back to 211 for a second, and when we were dealing with merchandising businesses. If you're in the business of selling jeans, then what do? How do you get the jeans? Well, you buy jeans in order to sell jeans. So for every pair you sell, you have to buy a pair, right? So the cost of jeans themselves is a variable cost. The example would be if I sell a pair of jeans for $60, but I only pay $5 for them. Well, if I sell one pair of jeans, my cost is $5. If I sell 2 pair of jeans, my cost is $10. 3 pair of jeans, my cost is $15, and so on. So you'll see that cost just keeps changing with every unit that I sell. That would explain the variable cost. Another way that we can classify cost is by its traceability. We're going to see these terms, direct and indirect, a lot throughout this semester. Direct cost explain a cost that is traceable to any single cost object, and it says material and labor costs for a product. Whereas indirect costs are those that cannot be traced to a single cost object. I'll give you just a real quick example. You have to become a bit of a visual, especially in an online course where you're just hearing me talk and a slide that doesn't move. But I'm a very visual person, and you'll get to understand that pretty quickly as we go forward. So what I want you to envision is that we are a manufacturer, and we manufacture bicycles. So obviously we have one room on the side of our factory floor that has all of the materials, all of the things that we need to make a bicycle. And here on the factory floor, there's a bunch of work tables, and there is a person who works at each table. So we're going to talk about John. John has a bench on the factory floor. We pay poor old John $12 an hour, blue-collar worker. He doesn't make much money. It's time for John to make a bicycle. Someone has put an order in for a bicycle. John walks over to the storeroom, and he gets all the stuff he needs to put this bicycle together. He gets some handlebars, a seat. He gets some tires, some wheels, some pedals, some chains, all of the different things that he needs in order to make a bicycle. He brings them from that storeroom, and he puts them on his workbench, and he starts putting it together. Well, the first thing I'll tell you is that the cost of all the parts, the handlebar, the seats, the frame, those things are all direct materials. I can trace the cost of those things, those parts, into this one bicycle unit. Furthermore, I can trace the cost of John turning wrenches to put that bike together. If it takes him an hour to put the bike together, then I can put $12 worth of labor cost into that bicycle. Therefore, those parts are direct material cost, and John is a direct labor cost. On the other side of this, for indirect cost, let's think about the supervisor who walks around the factory making sure that John and all of his peers are doing their job appropriately. I can't track the cost of that supervisor to any one bicycle because he's there for the benefit of all bicycles. So he is an indirect cost. Another example of an indirect cost would be the janitorial team that cleans the bathroom in the factory. I can't really attribute their cost to any one bicycle, but I really need them to clean the bathrooms. Otherwise, I might not have anybody here to work tomorrow because the bathrooms are disgusting. So I need them, but I can't trace them into one cost object. Therefore, the janitorial team for the factory is also an indirect cost. That's classification by traceability. All right, so let's compare, do a classification by function. So all costs can be considered either product cost or period cost. And this one's actually pretty easy to remember. Basically, if it's a product cost, it is a cost that happened inside the factory. We just talked a little bit about direct material and direct labor quite plainly. The cost of the parts that John brought to his bench, the cost of John himself. So direct labor, direct material, definitely product cost, and those things happen in the factory, don't they? We're talking about John putting parts together in the factory. But what about manufacturing overhead? Manufacturing overhead, as you'll see in a minute, kind of has a strange definition, but manufacturing overhead is all of the other costs that happen in the factory. The janitorial team is manufacturing overhead. The factory supervisor is manufacturing overhead. The rent for the factory is factory or manufacturing overhead. So basically, product cost is any cost that happens in the factory. It's a cost that happens directly related to creating the product itself. Any other cost is considered a period cost. It's something that is not directly attached to the product, such as administrative costs, the CEO of the company accounting office. And then selling costs, those costs that happen over in the store so that they can sell those bicycles. Advertising costs, those types of things are all going to be period cost. These diagrams, not my favorite thing in the world, but it's really intended to just kind of show you the flow. So here's year 2015 cost incurred, and we're just going to split them first by either period cost or product cost. Period costs are simple. They're just straight up expenses, and they're going to go straight over to the income statement in the year that they're incurred. But what happens to those product costs? Well, product costs are inventory. That's really what they are, because they're happening there in the factory. We're talking about the creation of our product. We're actually making the thing that we're going to sell. And if product cost results in inventory that we sold in the current year, if you sell it, you should already know that it becomes cost of goods sold. We transfer it out of inventory into cost of goods sold. But if we don't sell it until a later year, it's going to remain, all of the product costs are going to remain in inventory on the balance sheet until they're sold in a later year, and then converts to cost of goods sold. And what's interesting here is that there are 3 different types of inventory accounts now. Up until now, we've only ever had one merchandise inventory account, and that's because we just bought goods to resell them. But now we're actually creating goods. We're creating them, and all of those things are going to stay in inventory until sold. So again, we've talked just about a couple things. We can classify by behavior, fixed or variable. We can classify by traceability, direct or indirect, and we can classify by product or period. Every cost can be put into these 3 classification pools and is either or within each pool. Let's just look at a couple of them. Bicycle, tires, and wheels. That's the parts that John went to get. Fixed or variable? Definitely variable. The more bicycles I'm going to sell, the more tires and wheels I'm going to need to buy in order to create more. So definitely a variable expense. Can I trace bicycle tires and wheels straight into the bicycle? Absolutely. That's going to be a direct traceability. And does it happen in the factory or not? It absolutely happens in the factory. So that's going to be a product cost. Let's look at the production manager salary, since we talked about him. It's a salary. That's a fixed thing, right? The salary doesn't change. Whether you sell anything or not, the salary is really not going to change. The difference is the wages of an assembly worker who is probably hourly would be variable. But this is a salary, so it's fixed. Can I trace the cost of this guy into the product directly? And the answer is no, he's indirect. But does it happen in the factory? And the answer is yes, it does. Look again down here at sales commissions. Variable, right? That's a variable thing. The more I sell, the more I have to pay out in commissions. So that's variable. Definitely indirect. It's not a direct thing. I can't trace that directly to a cost object, and it doesn't happen in the factory. It's a period cost. Can service companies use these same cost concepts? Absolutely. Accounting firms, legal firms, and even airlines, as we can see here, are able to use these very same cost concepts. We use these cost concepts at my firm here in downtown Fredericksburg. Every tax return that comes through our front door is a project, and we track cost against that project. Here's a great example, though, for Southwest Airlines. Beverages given to passengers, not the ones they have to buy, but the beverages given to passengers are considered a variable cost based on the number of passengers. The more passengers you have, the more the cost of beverages goes up, because you have to buy more of them to provide. Interesting graphic here, typical manufacturing cost in today's products. This text is probably a couple years old, but it probably hasn't changed much since then. You'll see direct materials about 45%. This is the interesting thing here. Direct labor at 15% and factory overhead at 40%. What's interesting to me is that when I graduated from college in 1995, these two numbers were probably almost exactly flip-flopped, with factory overhead being 15%, direct labor being about 40%. My question to you would be, what's changed? And most of you are probably already thinking, well, technology's changed since 1995. There's much more manufacturing automation at this point, which doesn't require as much labor. And certainly machinery in a factory would be considered overhead, because you can't really allocate the cost of machinery down to one cost object. So the cost of machines would be indirect and thus be factory overhead. A little bit more about direct materials. I think we've explained it already pretty well. Direct material directly traced, such as the frame of a mountain bike. Same thing with direct labor. It's the labor cost that we can directly trace into our finished goods, such as John sitting there turning wrenches. Maybe that bicycle has to go over to another station to get painted, and the person who has to paint it would obviously be directly traceable as well. And then factory overhead. Here's that strange definition I was telling you about. The true definition of factory factory overhead is all manufacturing costs that are not. So it's a negative definition, all costs that are not direct material or direct labor, and they can't be separately or readily traced to finished goods. That's why it's very important to understand traceability, such as maintenance in the factory, cleaning supplies for the factory utility costs, factory supervisory costs. The rent for the factory as well would be another factory overhead. Prime and conversion cost is just one other way that we can kind of separate things out to help us with our details. You'll never see this on a test or a homework, I promise. So if you want to plug your ears at this point and just not even listen to this slide, I would completely understand. Prime cost versus conversion cost. Prime cost is meant to be those costs that go straight into the product. Well, that's always going to be just direct material and direct labor. But conversion cost is going to be the cost of what it takes to convert raw materials into a finished product. So obviously it takes a direct labor piece, but it also takes all of that manufacturing overhead. You've got to have a factory in which you've paid rent for, in which you've paid for a janitorial team, and you've had a supervisor in order to convert, being the root word, to convert these raw materials into a product. Okay, so let's just talk about the balance sheet for a manufacturer real quick. Again, we know what merchandisers do. They buy goods and they sell goods, and therefore we only ever had one inventory account. But for manufacturers, we buy raw materials and then we sell finished goods. Well, raw materials is going to be an inventory itself, and then the finished goods is going to be an inventory. And what you'll see here soon is that there's an in-between as well that we're going to talk about. So here's current assets for a merchandiser. We know they have cash receivables and one inventory account. You'll see our primary difference is inventory, and that's because the manufacturer has 3 inventory accounts now to deal with. We buy raw materials, and then John goes and gets those raw materials and puts them on his bench. And while raw materials are in that process of being converted, while they're sitting in the factory being converted into some usable product, we call that work in process or goods in process. And that in and of itself is also an inventory account. So what goes into goods in process? Well, the cost of the raw material that we took out of the raw material storeroom and brought to John's bench. And then the cost of John himself as he puts that item together is also considered work in process inventory until it's done. Once that bicycle is finished, it's all put together, it's been painted, it has decals on it, then the total cost of it, all of the cost of material, all the cost of John, and all of the overhead that would be allocated to that one bicycle then gets transferred from goods in process over to finished goods. So the primary difference though between these two are going to be inventory. We just explained this again, raw material, goods in process, and finished goods. Just to explain a little bit more about where John is. Remember, John is sitting on the factory floor, and that's what this goods in process is. It's basically all of the partially complete products to where we have put in material and some labor and some overhead. And when this is complete, it becomes the finished goods, which are completed products for sale. Let's look at what happens to the income statement for the manufacturer. This is a formula that you should have learned in Accounting 211 or Accounting 101, and it's a really important formula because we use it in all of accounting. There are only a few formulas in accounting that you really should work to remember. In my book, everything else is just research based. If you don't know how to do an income statement, go look up an income statement because you can see how to do it. But there are just some formulas that we use over and over again. This is one of them, and interest calculation is another, and there's a few other that we'll learn as we go through. But this is certainly one. Anytime we're thinking about tracking the cost of an inventory, we always start with beginning inventory. We then add in what we've purchased, and then we take away our ending inventory, and it determines the cost of what we've used up. What did we take out of inventory? Another way to state this, right, would be beginning plus what we've added in minus what we used up would equal ending inventory. It's just straight out algebra, right? We can just move the equation around a little bit. But anytime you want to find the cost of what you have used up, you take the beginning plus what you added minus the end. Same thing for the manufacturer. This was accounting 211 or 101. This is the manufacturer side. Here's the beginning plus what we added in. The difference here is that we don't purchase it anymore. We manufacture it minus our ending is still going to give us cost of goods sold. Here's what it's going to look like if we just bring it out with numbers and a calculation. This was for a merchandiser. Again, we started with beginning. We purchased some stuff, and that gave us what was available for sale. We take away the end, gives us cost of goods sold. But for the manufacturer, we take the beginning plus what we've manufactured. Notice that it has an asterisk. Minus our ending gives us cost of goods sold. The reason there's asterisk there is because we have to figure out how to calculate cost of goods manufactured. It's going to take just a little bit more than going and finding receipts for what we purchased, because now cost of goods manufactured contains raw material, but it also, which is direct material, but it also contains direct labor and it contains factory overhead. So there's some stuff that we have to add together to get to that number. So it's going to take a little bit of a breakout. Just another cost flow in manufacturing, just another way for you to see how this works. You can look at this graphic and just try to trace this through, but we've already kind of talked this through as it would be. Let's talk about that schedule of cost of goods manufactured. Here it is. It's the same formula. If you really think about it, that formula I just showed you that said you should remember this, it's the same thing. Remember how I said beginning inventory plus we add in minus the ending equals what we've used up. It's the same here. They've just kind of reworked it a little bit. They've put the beginning down here, added it to what this is our add-in minus our ending. It's the same thing. Beginning plus what we've added minus our ending gives us what we've used up. That's our cost of goods manufactured. In this case, what we're adding in, though, is that work in process stuff. It's the direct material used, the direct labor applied, and the factory overhead applied that gets us total manufacturing cost. And when we run through this calculation, we get cost of goods manufactured. Don't let this slide scare you, because it's a little scary. You might, at this point, this is when people are like, okay, done, exit. I think I'm going to drop the class because this is too much for me. Don't give up on me yet. It's a little bit easier than it looks. Look at just the direct material piece. Remember I said if we're doing cost of goods manufactured, we've got to take direct material, direct labor, factory overhead, we add it to the beginning, we take away the ending, and that's what gets us there. Well, this isn't anything crazy. This is direct material, right? Well, direct material is an inventory. That raw material is your direct material, and that is an inventory account. Well, how do we calculate what we've used up? We go back to that same formula. Here's my inventory at the beginning, plus what I added in, minus my ending equals my direct material used. That's how it's calculated. Nothing new, nothing interesting. It's just the same. We just have to know how to apply that formula. We then add in the direct labor. That's easy to get because it comes from payroll. Well, we're dealing with product cost here, right? Total manufacturing cost should be product cost. We know at this point, we just learned it, that direct material, direct labor, and factory overhead, these three things, important to know this, direct material, direct labor, and factory overhead, these three things are what makes up your product cost. And how do we define factory overhead? Well, it wasn't that hard. Factory overhead is everything that happens in the factory that is not direct material and not direct labor. So look at what's there. Indirect labor, factory supervision, factory utilities, repairs on the factory equipment, property taxes for the building, factory supplies used, factory insurance, and then depreciation on the tools, the equipment, the building, amortization on the patents. All the stuff that's not direct materials and direct labor. If they had somebody cleaning their bathrooms, the janitorial team would be in here as well. We add those three things up and we get total manufacturing cost. We add in the beginning, we take away the end, and that's what gets us cost of goods manufactured. That's that same 170,500 that we just saw 3 slides ago. And now the PowerPoint wants to explain everything to you that I just did. All right. This is just another overhead cost flowing across accounting report. So you'll see the cost of goods manufactured moves over to the income statement. There's, again, how we're going to end up calculating cost of goods sold, beginning plus the cost of goods manufactured minus the ending finished goods gives us cost of goods sold. Any ending work in process is still an inventory account, so it should remain on the balance sheet as well. That finished goods inventory, obviously, remember that's going to be related to the calculation of cost of goods sold here between the two. So remember, in accounting, those financial reports all talk to each other. All right, so finally, let's talk just about some trends in managerial accounting. We've got a few of them to talk about here. I'll tell you that a lot of these are relatively new in the world of accounting. And when you say it's relatively new in accounting, that means it's probably less than, 20, 25 years old, because accounting's been around for a long time. When I graduated from college, a lot of these things just didn't exist. E-commerce was almost unheard of. We were already approaching a service economy as it was. Global economy only on very, very big scale stuff. You and I could not really go buy stuff from China back in 1995. Lean practices and value chain was something that was really only being thought of, and you would probably really only hear about at the elite business schools. Customer orientation was something that we were starting to deal with at that time because we were coming into an era in which some bad manufacturing practices and very low quality products were being produced in the United States in the late 80s and early 90s. And we started kind of getting a grip on that and realizing that we needed to make our customers happy. We couldn't just throw them products, and if the products were bad, they would just throw them away and buy more because they were cheap. Customers weren't happy with that at all, and they really started going overseas to buy products. We don't want to buy from the USA anymore because foreign products are better. So we had to really start getting a handle on that, and that's where this theory of customer orientation really came from. So around customer orientation is the theory of continuous improvement, and continuous improvement is really kind of the philosophy that good enough is never good enough. And if good enough is never good enough, you will continually improve. You will strive to continually improve. And that's to keep your customer happy. Our customers are expecting us to continually improve what we do. Total quality management, we'll talk a little bit more about in just a second, as well as just-in-time manufacturing. Let's just move over to total quality management real quick. Total quality management is going to say that we're going to apply this quality improvement plan to all aspects of business activities. That makes sense, such as encouraging employees to try new methods. Don't just leave it on the on top management, because they'll never get anything done. Seek and uncover waste, emphasize value of quality through quality awards. It really is a constant focus on higher standards in totality for the entire company. Just-in-time manufacturing was something that really was kind of brand new as I was graduating back in 95. And it's really because overnight delivery services like FedEx were pretty new. We hadn't really seen anything like that until then. And because of that, we were able to basically get a customer order, receive the materials as we needed them to produce. We didn't need to keep materials sitting on a shelf for any long period of time, and then we would complete the assembly right away and then deliver it right back out to our customers. So that's what just-in-time manufacturing is all about. And then there's this value chain, which really just talks about the series of activities that can add value to the products or services of the company. And with that value chain, we use the lean practice model to help us increase efficiency and profits. And lean practices really focuses a lot on saving as much time as you possibly can and cutting cost as much as you possibly can without cutting quality. So in this value chain, we're looking at what is the value that we can apply to acquiring raw materials? Are our purchasing methods appropriate? Are we going about it the right way? Is the processing itself efficient? Are we making sales? Are we reaching our customers? Are we doing what we need to do? And then after we sell it, are we servicing our customers? And that's why it's still a part of customer orientation, is because we really are focused on keeping our customers happy. And that will complete chapter 14.